Yeah, so happy Mashujaa Day to everyone. So we were supposed to start from IFRS 16, a new topic. That is where we were supposed to start from. Yeah, so I shared with you the notes. So I believe you wrote the notes. If you have not, please make sure umeandika. So I want us to go through those notes very fast. You have the notes in the group. I hope everyone has access to those notes. So I want us to go through the notes, then we check the relevant questions, which we can be able to solve. So a lease, we are going through the notes. A lease is an agreement whereby one party, known as the, not called lessor, but the correct pronunciation in the dictionary is lessor. So a lease is an agreement where one party, known as the lessor, conveys to the lessee in return for payment or series of payments the right to use an asset for the agreed period of time. So one party gives out the assets expecting receipts, payments from the other party. So the party giving out the asset is known as the lessor. This is now the owner of the asset, while the lessee is the one who uses the asset and makes payments to the lessor. So we have key terms. So terminology is number one, commencement of the lease is the date from which the lessee is entitled to exercise the right to use the leased asset. So commencement is the date when the lessee, whoever the asset was given to, has the right to start using that particular asset. Then inception of a lease. Inception of a lease is the earlier of the date of the lease agreement and the date of commitment by the parties to the principal provision of the lease. So the date they entered into the contract, but before the lease, so inception comes before commencement. So at the inception, we just sit down and write some agreement. This is how it will be. So if the agreement is honored, Francis is asking someone to share the notes. So maybe Linda, can you repost the notes for the list in the group kindly? Maybe you can do that. You can just scroll up there. It is somewhere up there. Then you can post. I hope that has been done. Thank you, Direction. So we have inception when they agreed. So if the agreement is honored and the lessee has been given the assets, then now that is commencement. Then economic life is the period over which an asset is expected to yield economic benefits to an entity. The period over which an asset is expected to yield economic benefits to an entity. Economic benefits is when you expect returns. Then we have contingent rent, is that portion of the lease payment that is not fixed in amount, but which is based on certain future factors, e.g., percentage of future sales. So we can enter into a contract that if you sell more than 10 million, you will pay me this amount. So the rent is not constant. The rent depends on some factors. So the amount, what the lessee pays to the lessor is known as the rent. So if the rent is not fixed, there might be fixed parts and there might be a fluctuating part. The fluctuating part is now the part which depends. It depends on certain future factors. That is called contingent. Contingent means subject to. So that part of rent which is not constant but depends on some factors is known as the contingent rent. Then we have gross investment in the lease. Is the minimum lease payment receivable by the lessor under a finance lease, and any guaranteed residual value accruing to the lessor. So gross investment, to the lessor is the owner of the assets. So there is that amount which the lessor expects to receive from the lessee. That is what we call the gross investment, the minimum amount which they expect to receive from the lessee, plus any guaranteed residual value. Then we have unguaranteed residual value, is the portion of the residual value of the leased asset on which a lessor is not assured to receive at the end of the lease term. When the lease comes to an end, there is always two options. The lessee can remain with the asset, or the lessee can give back the asset. So at the end of the period, you can agree that this amount, this one you will have to pay me upon the lapse of the lease. This one you may. Niliona siku ingine kwa parliament, siku could have the strong terms, may and shall. So when we talk of may, you may be able to pay this at the end of the lease term, then that is known as unguaranteed residual value. While guaranteed down there is that part of residual value that will have that I think about the legal reason. Is that part of the residual value that the lessee will have to pay the lessor at the end of the lease term. So when you agree, when the lease comes to an end, you have to give me this terminal amount. That is called guaranteed. But the amount which you are not sure it may be paid, not a must, then that is called the unguaranteed. We have what is called interest rate implicit in the lease. So interest rate implicit in the lease is the rate of interest that a lessee would have to pay, having taken into consideration the present value of the lease payment. So interest rate implicit in the lease is just the rate of interest for charging, for charging annual or periodical interest as time goes by. So in the questions, if the examiner tells us the interest rate implicit in the lease, then that is the rate you're supposed to use to calculate the interest on the outstanding amount which has not been honored by the lessee. Then lease incremental borrowing rate. Lease incremental borrowing rate is the rate of borrowing on similar terms and on similar assets. Here in our maneno. Types of leases. So we have two types of leases. We have a finance lease and we have an operating lease. Finance lease and operating lease. So we proceed. What is a finance lease? What is a finance lease? A lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership to the lessee. It transfers all the risk and rewards into the incidental to ownership to the lessee. So in a finance lease, all the rights to the usage of the asset, all the obligations are transferred to the lessee. Check out these rental houses, which people normally rent in the urban areas. Those are not finance leases. All the rights, even some rights are restricted. I remember there's somewhere we used to stay sometimes. When you come back to the house which you have rented and you're paying rent, if you come back at around 10 p.m., Kulikuwa na caretaker na kwambia hapo kwa small window, just go back. You cannot enter. So you don't have full rights. Neither do you have obligations, because unapata kama kumeharibika sijui nini, unaita caretaker yeye mwenyewe ndiye anatengeneza. So that is an operating lease. You don't have the full rights and even obligations to the leased asset. But a lease whereby, kama gari, we can enter into agreement for a vehicle. Wewe ukichukua hiyo gari on car hire, uende ubongeze hapo, utarekebisha hiyo gari, mafuta wewe weka, endesha hiyo gari venye wewe unajisikia, hata kama unataka kuenda 150 kilometers per hour, that is upon you. So an asset and a lease in which the rights and obligations are with the lessee, that is a finance lease. In operating lease, the rights and obligations to ownership may or may not be conferred to the lessee. We proceed. Characteristics of a finance lease. So in the question, they might not tell you this is a finance lease, but there are some attributes, features, which when you see, you can be able to tell that this is a finance lease and not an operating lease. So number one, it transfers the ownership of the assets to the lessee by the end of the lease term. Yeah, in most finance leases, upon the expiry of the lease period, the asset, the ownership of the asset is retained by the lessee in most instances. Number two, the lessee should have the option to purchase the asset at a price lower than the fair value at the date the option became exercisable. Because the title of ownership normally remains with the lessee, at the time of inception, anapewa even option of purchase to purchase that particular asset. So, wezi enda na landlord, mwambie ile siku umekuja kutafuta hiyo nyumba nataka kuishi, mwambie ati hii nyumba nilipe hiyo rent ya 10,000, ama hata unaweza niuzia hii nyumba. Instead of me paying rent, in most cases, in operating leases, but in a finance lease, ati sasa unataka kunipatia juu sasa wewe umemaliza shule, unanipatia calculator yako. And ati sasa hii is on a lease term, unatumia calculator per day, utakuwa unatumia 10 shillings. I can be given an option to buy. So at least whereby the lessee is having option to purchase that asset, that is a finance lease. The leased assets should be of a special nature, such that the lessee can use them without any major modifications. That one just means it should be in the right condition. Then the lease term should form a major part of the economic life of the asset, even if the title is not transferred. I repeat, the lease term should form a major part of the economic life of the asset, even if the title is not transferred. So if the economic life, economic life is the period the asset is expected to be economically useful. So if the economic life was to be 10 years, let the lease period not go beyond the economic life, because after economic life, the asset is considered to be worthless. So let it be maybe ibaki, if the economic life was 10 years, na sahi asset ibaki in economic life of 7, for example, then the lease period should not go beyond 7. It is either 7 or below. So the asset, the economic life and the lease period should almost be similar to each other. Operating lease is any form of a lease other than a finance lease. Actually, that is how the standard defines operating lease. Any lease other than a finance lease is an operating lease. It means any lease which does not have any of those characteristics is a finance lease. The title of ownership is retained by the lessor during and after the lease period. So the owner of the asset will always retain the title of ownership. Risk and rewards are not transferred to the lessee, and all the incidental costs are to be incurred by the lessor. Yes. NB, that NB is very strong. In the new standard, that is IFRS number 16, Both operating and finance leases are accounted for as finance leases. However, the lessor is expected to account for leases separately. So this standard is very new, very. I think it came in 2019. It's still new. We used to apply IAS number 17. So currently, and I want you to understand this properly, there is no difference between an operating lease and a finance lease in the books of the lessee. So what happens, the lessee, regardless of whichever form you enter, you account for the leased asset as if the ownership will remain with you at the end of the lease term. Now, when it comes to the operating leases, what happens? You see, like let's say the premises where Destiny College is, that is not our premises. It is on an operating lease. So what happens? You need to determine, you can tell in advance, what is the lease period? So let's say the lease period is 10 years. How much are we paying per year? We are paying this much per year. So you can be able to know how much we pay for the 10 years period. So if you calculate and you realize after 10 years, we'll have paid 30 million, then that 30 million is your right to use. You are right to use that particular asset. So in the financial statement, the asset, and that is what we do. That is what we do. And what I expect, because I realized most of the accountants are not doing this. Ati wao kitu wanafanya, wakishalipa rent, even at workplace, for those who are operating on premises which are not theirs, once they have paid rent, they credit the cash book, then they expense the amount. That is okay. Apart from doing that, you need to recognize an uncurrent asset in respect to whichever form of a lease. So what happens? We know that year one, for example, we are supposed to pay a total rent of 10 million. So this 10 million, not that way. For the entire lease period, we are supposed to pay 30 million. Then at the end of year one, we have paid 10. So the amount which is remaining, we have paid 10 million. The amount which is remaining at the end of year one of 20 million, you bring this 20 million in the books as an asset. Though the building is not yours, and therefore you cannot recognize building. You cannot say building. You are not allowed to recognize when you go to IAS number 16 on property, plant, and equipment. You are not allowed to recognize assets which does not belong to the entity. You only recognize the assets which an entity has ownership to. Therefore, what you're supposed to recognize, you need to check to recognize what is called right of use assets. That is what you recognize in the financial statement. Can you Google from your Google platform? Just Google for me this word, right of use asset. You can even copy paste the we can all read. Someone to do for me that. So this is what you need to recognize in the financial statements. So when we'll be dealing with leases and we are preparing the financial statements, we don't recognize that leased asset as an asset in our books. Instead, we recognize what is called right of use, and it is recognized as an asset. So you don't take the premises or motor vehicle on lease agreement as your asset. No, you recognize what is called right of use, regardless of whichever lease it is, whether it is operating or it's a finance lease. You recognize right of use asset. Somebody to copy paste that for me there from your Google platform. What is the meaning of right of use asset? What is the meaning of right of use asset? Thank you. let someone not copy paste again. Someone has done that. Tracy has done that, so I can read. In lease accounting, I'm reading what she has posted, which you can also check. In lease accounting, a right of use asset, that is ROU, is an asset that represents a lessee's privilege to use the leased item over the duration of an agreed upon lease term. In other words, the lessee is granted the authority to obtain the economic benefit from the usage of the asset owned by another entity. So the way we have said, the asset is not yours, but you have the right. The right you have is dictated with the amount under the lease, the amount which you will pay. So the value of the assets becomes your right of usage. Then, as time goes by, you do what is called amortization. Amortization is now whereby you check interest if they have not paid. So you take the principal amount plus the interest, then you subtract the actual rent which has been paid. So when you take the principal plus interest minus the actual interest paid, the balance remaining is called amortized cost or amortized value. So you keep on reducing, and the reduced value becomes your ROU, right of use assets. So in the financial statement, when dealing with leases, you recognize what we call right of use. Please master that. And this from let me be very exact. So those people who are Googling, just check for me. Effective date of IFRS 16. Effective date of IFRS 16. Just Google, search for me that. I don't know that it's 2018 or 19. Somewhere there. I think that is when this standard came to force. Please check. Tuko CBC, so Google, hata tungekuwa na inaweza fanywa na nyundo tungeendelea. So check for me the effective date of IFRS 16. When was this standard effective? If you type that, you'll be able to get it. Someone to check for me. Knowledge is power. It's good to know. IFRS 16. Who has given me that still? Okay. IFRS 16 is effective for annual reporting period beginning on 1st January 2019. Yes. So this standard came to effect in 2016. It replaced another standard known as IS number 17. So this one here was very discriminative. Operating leases were not being recorded as assets in the books. Hakuna kitu kama right of use. Wewe lipa landlord, recognize an expense, credit cash book, story ends there. But with this new standard, in the books of the lessee, there is no distinction between a finance lease and operating lease. And for those of us who are the ones in charge of accounts, please make sure this is something you start recognizing. Though kuna some bosses hawataki hata accountants wajue hiyo rent ya hiyo office inalipwa pesa ngapi, they don't want people to know. But immediately you know, and you are in the charge of preparing the financial statement, or you can even interrogate the accountant, whoever is in charge of financial statement, you want to see that balance sheet. If you realize the accountant plus the auditor, they are not recognizing that, then you tell them you are contravening the provisions of IFRS 16, which you were told by CPA Juma. I've told you that is what happens. And most companies are doing, or they don't recognize that. It means those financial statements are not being prepared in accordance with the relevant required standards. You check the amount outstanding in the rental, then that one is what you bring as the right of use because you intend to pay it. Thank you. I wanted to elaborate on that thoroughly because it's a new area which needs more clarification. Let's proceed with our notes. Accounting for, sorry, before we proceed, the lessor owner of the asset, and account separately. Finance lease and operating leases. They don't combine. They don't combine the two. Upon lease commencement, the lessee should recognize a right of use asset and an obligation in the statement of financial position. Yes, maybe I never mentioned the obligation part. Remember, as far as unarika hapo ati uko na hiyo asset hapo right of use, the asset here. So you cancel it down here as a liability. You know, when you recognize asset and liability at the same time with the same value, it cancels out automatically, meaning that it's yako. So at commencement, you need to recognize both asset and liability in the financial statement, because that amount you are recognizing, you will pay it over the period, so that at the end, you have cleared everything and even the asset is no longer in the financial statements. Right of use asset is considered to be the value of the leased asset less the accumulated depreciation. Full stop, nothing much. So allow me to take you to illustration. So write the illustration. Past paper, you only have one question for lease, which will be our last. So I had prepared some questions for you here in a certain handout, which I want to share with you. Just give me a minute or so. I want to look for it where I saved it. So I've shared the question. So open that handout. So that handout has 3 questions. I'll start with question 1 of the handout. Let's start with question 1 of the handout. And it says, on 1st January 2019, JM Limited leased a machine from JT Machine Limited under a finance lease agreement. JM Limited was to make installment lease payments of $14 million every 6 months on 30th June and 31st December in arrears. So in a year, they were making payments twice, June and December. The first payment was made on 30th June and 31st December. Oh, I think that's a repetition. There's a repetition there. The fair value of the machine was $60 million with an estimated useful life of 3 years. The interest rate implicit in the lease was 10% per 6 months, not per year, per 6 months, per 6 months. Required extract of the statement of profit or loss for the year ended 31st December 2019 and 2020, and extract of the statement of financial position as at 31st December 2019 and 2020. So we can kick off. You say, at inception, debit, right of use asset with 60 million. Then you credit lease obligation. You credit lease obligation, also 60. That is the first entry at the inception or at commencement. But inception, that is how the entry should be. So the value of that asset is 60. So this is, we are only dealing in the books of the lessee. We are in the books of the lessee. So the value of the asset, you debit it in the financial statement, then you credit the obligation. They will have to pay that amount. Then from there, you say annual depreciation. They have said the lease is going for 3 years. So depreciation in the books of the lessee is based on the lease term, not useful life. You know, useful life can be 10, and we are supposed to use it only for 7 years. So the books of the lessee, you depreciate the asset for the duration of the lease period, not economic life, unless they are equal. So you will come here and say it is 60 divided by the 3 years, the 3-year period. So per year, we need to charge depreciation of 20 million, the financial statement. We have started, and I hope we are moving together. Very good. So you need to conduct what is called lease amortization. you need to carry out what is called lease amortization. You need to carry out what is called lease amortization. So lease amortization will have here period. You'll have balance brought down. Then interest. The interest implicit in the lease, they said it was 10% per 6 months. So this is 10%. So you will take the opening balance plus the interest, but now you subtract the actual rent paid. So rental paid. Then from there, you will have the closing balance carried down there. So like that. They were paying twice in a year. So the first payment, so 20, we'll have here 2019. 2019, there is June and there is December. The payment was being made twice. 2020, also there is June and there is December. Though the lease period was 3 years, in the required, the extract I've seen it ends in 2020, but less amortized and up to the end of the lease period. For 2021, June and December. Like that. So rent, they were paying 14 million after every 6 months. So that is constant. And once you pay rent, you reduce your obligation. So 14 million after every 6 months. So you subtract. Once you pay, your obligation is reduced. So that. So have those amounts. The ones paid, you have to subtract. So the opening balance is 60. So then there is charge of interest. It was per 6 months. So 10% of this will be 6 million. So it will be 60 plus 6 minus the rent which has been paid. How much is that? I think nikingoja itakuwa mingi. So I can just, that is 66 minus 15 should be, minus 14 should be 52. In case I go wrong somewhere, you tell me. Then 52 will be the opening. Yeah. So you bring 52 here. So that will be 5.2. That plus that minus that is around 43,200. Don't copy, make sure you are doing it. So this one also will be the opening, 43,200. So this will be 43, like that. So 43 plus 4 is around 47,20 or thereabout. Minus 14 is around 33,520. 33 or 32. A book on farm. Copy at your own risk. 33,520. And that one also becomes the opening, 33,520 times 10 is 3,352, like that. Then if you adjust, you're likely to get what? So 33,520 plus 33,52 minus 14. 22,872. So this is 22,872. So this will be 22,872, like that. So that one plus 22, 87.2 minus 14, 159, 200. This is 159, 200, 10%, 59, like that. So plus 1159, 1159. -2 minus 14. You're getting, I did the correct thing. 11, 159, 200 plus 11, 59, 20 minus 14. You get a negative figure. In amortization, once you get a negative figure, means they have paid everything. So here you have nil. In lease accounting, a negative figure means the amount has been paid in full. So you just recognize nil. So I hope someone to confirm that you got the same figures. Just confirm that you got the same figures, because from here now, we are going to be able to extract the financials which they want. Kindly confirm whether you have the same figures as those of mine. Data confirms. Those who are not done, finish that amortization. But now let's answer the question. The question wants us to come up with an extract of profit and loss account. So allow me to delete here because I really need this schedule. So I'm working in the books of the lessee. Lessee is the JM. So in the books of the lessee, I write here JM Limited P&L extracts for the year ended 31st December 31st December. Correct. So they wanted for 2019 and 2020 only. All right, so extract means just give us what you can see. JM is the lessee, so there is no income. Extract, there is no income. They only have expenses. So expenses, one of the expenses is depreciation. Depreciation should be charged in the books of the lessee. Yeye ndiye anatumia hiyo assets. So depreciation is charged in the books of the lessee, not lessor. So depreciation was constant per year at 20. So annual depreciation was 20. Then there is this interest. There is the annual interest which they are being charged. So you say finance charge. Finance charge is the interest. Finance charge is the interest. But you see, the interest here was for 6 months, but the books are being prepared on annual basis. So you will combine 2019, you will take this one here. 2020, you will combine these two because these ones are 6 months, 6 months. So you combine. So this one will give you 11,200 when you combine. Then this other one will give you 76, 72. 76, 72, like that. So we are done. Extract, still lazima you add, but you can add if you wish, but there is no need. Extract, they just want to see those figures and the one. So those are the only expenses which I'm capable of seeing for 2019 and 2020. If you are to do 2021, then it's also you add these two. So please have that. Have that. Yeah, it seems no one has a concern. So let's go to the statement of financial position. Statement of financial position. Hapo ni kuna story ingine hapo umepotea. So let's be together. So JM. Statement of financial position. Extract. As at 31st December. So 31st December, they want 2019 and 2020. All right. So non-current assets, we have right of use asset. So right of use asset, the value was 60. It was 60. But now the asset is being depreciated. The asset is being depreciated. So you less accumulated depreciation. You less accumulated depreciation. So year 1, 20. Year 2, you accumulate 20 plus 20, 40. Like that. So the net book value, which is the NBV, so NBV, net book value, this is 40, this is 20. So that if we were to go for year 3, it will be 60 minus accumulated 60 nil. So have that. Then now, the one which now gives people headache is this one here. Liabilities. Liabilities. So we have non-current or long-term. We have long-term obligation. And so you write here non-current obligation. Sorry, non-current lease obligation. Non-current lease obligation and current lease obligation. Like that. So it will end at that stage. Have those two. I know those two normally brings problems. So we have to be keen, very keen. Okay. Now, listen and listen carefully. How do we define the simple definition of an uncurrent liability? An uncurrent liability is an obligation which is not expected to be paid in the next 1 year. Next. Angalia the word next 1 year. While current is payable within the next 1 year. So when you come to the schedule, this amortization schedule, please, so I really need your high concentration. At the end, remember the balance sheet is prepared at the end. At the end of 2019, the total outstanding amount which had not been paid is this one here. We are not paid. Deni yenye tuko nayo kwa hiyo list is now 43,200. 43,200. So of this 43, ukiwa na deni, you split it into two. There is part which will be paid in the next 1 year, and there is part which will remain. So what you are expecting not to be paid, right now you are expecting right now, will not be paid in the next 1 year, is a long-term liability right now. Especially for this, you can know. Because amortization schedule, you should do it in advance. So when unataka ukitake, umelipa hivyo. So what is outstanding, which has not been paid, the outstanding is 43. But you cannot say the whole 43 is a long-term liability. Because of the 43, there are some payments which will take place next year. So what becomes long-term is what you are projecting to remain. Out of 43, what will remain after 1 year is this one here. This is the amount which will remain after 1 year. So if that is what will remain after 1 year, then right now you recognize long-term, which will not be paid out of 43. Tunafunga, unaulizwa kama accountant. Jen, unaulizwa, how much have we not paid the landlord to date? We have not paid 43.2. Out of 43, how much do you think we will not pay in the next 1 year? What will not pay in the next 1 year is a long-term liability. And it is this one. You project next 1 year unaangalia mbele. So that is the amount you bring in 2019. So in 2019, the amount which we are seeing to be long-term is 22,872. That is the amount we don't expect to pay in the next 1 year. So it means out of 43, the difference between 43 and 22 will be paid in 1 year. So can you do for me that favor? Take 43,200 minus 22,872. What will you get? That one will be paid in the next 1 year, and it will be current in 2019. Get me the difference. Total was 43. 22 will remain after 1 year. So the difference between 43 and 22 will be paid in the next 1 year. How much is it? 20,328. 20,328. Thank you. So that one will give you a total of 43,200. Which is the total liability? This is the total liability at the end of 2019. So you just split it into two. The one which will not be paid after 1 year, and the one which will be paid in the next 1 year. If that is understood, to end the 2020. 2020, how much is outstanding? 2020 outstanding is this 22. 22 had not been paid by the end of 2022. So you need to split it into two, the current and the long term. Long term, check the end of next year. So end of next year, 2021, nil. There will be no balance to be paid. So there is no long-term liability in 2020. We don't expect any amount to remain outstanding after 1 year, meaning the whole amount must be paid. This 22,872 must be paid in the next 1 year. And we are done. Tumemaliza hiyo extract. So if you understand that concept, you are good to go. You check at the end, that one becomes the total. Total, split it into two. What will remain after 1 year? You project the next 1 year, that is long term. Then the difference between the total and the long term is the current. In 2020, it was 22, long term is 0. So the whole amount must be paid in the next 1 year. We are done with the question. We are done with the question. I want us to go to question 2 of the handouts. I want us to go to question 2 of the handouts. So thank you. Thank you, thank you, thank you. Thank you. Let's go to question 2. I want to delete this. Open your question 2. So question 2 says, a lessor leases out an asset on terms which constitutes a finance lease. The primary period is 5 years. A lessor leases out an asset. So this one is in the books of the lessor, the owner of the asset, which is good. Here we find the books of the lessee. So a lessor leases out an asset on terms which constitutes a finance lease. The primary period is 5 years, commencing 1st July 2016, and the rental payable is 3 million per annum in arrears. The lessee has the right to continue the lease after the 5-year period, referred to as indefinite period, at a nominal rent. The cash price of the asset in question, as at 1st July 2016, can be assumed to be shillings 11,372,000. The rate of interest implicit in the lease is 10%. Required, show the accounting entries in the books of Angelica Lessor Missouri, that's not the spelling. The lessor's books apply the requirements of IFRS 16. So we are now required to account in the books of the lessor. Number 1, the lessor does not recognize the right of use. It's the owner of the asset. So they will not recognize the right of use. Wow, recognize investment because they have invested in that particular asset. So they recognize investment. Number 2, they don't charge depreciation. Mimi ukinipatia gari yako, nianze kugongana na watu kwa barabara. side mirror nimegwaruza. Unajua ukigwara side mirror imedepreciate. I'm not supposed to call you ati gari yako mtu akikimbia side mirror inagwara watu wengine, hapana. Wewe tenganisha hiyo side mirror. So the lessor does not charge those depreciation in the financial statement. Yeye kazi yake ni kukaa nyumbani na kungoja pesa. So amortization will remain the same. We go to amortization straight away. Amortization will remain the same with the only difference on wordings. Where you are saying interest paid, now you say interest receivable. Where you are saying rental paid, you say rental received. So, but amortization remains the same. Let's do it. Let's do it. This is 5-year period. So that is question 2. Lease amortization. Lease amortization. Lease amortization. So you say here, balance brought down. See, let's reduce these thousands. Then finance, wacha tuipe jina mzuri. Finance income. Finance income 10%. So finance income is the interest. Then rental. So rental received. Then balance carried down. I have a suggestion now because you are understanding what is happening. I want to, amortization ends here, but I want to extrapolate it kidogo. Right for me here, non-current asset. You know, the owner of the asset talks of asset because it's an investment. Then here you talk of current assets, like that. So when we go to extract, tuko na kila kitu. You don't struggle against subtracting the way we were doing. But I don't want to bring that in the first question. But once umezoea, it becomes faster. Furthermore, amortization is a working. So it will just give you the figures. So have that. So here, it started in the year 2016. What has happened? Now, it started in 2016. So 2016 July is 2016, 2017. So me, I'll say 2017, 2018, 2019, 2020, 2021. 1, 2, 3, 4, 5. It started on 1st July 2016. So that is a 2017 financial year, 16, 17, like that. Then the rentals, they were receiving 3 million. They were receiving 3 million. Please, we can work in thousands. So 3 million every year. 3 million every year. 3 million every year. Have that. Balance brought down is that value. The value was 11,372. 11,372. So 10%, let's round off. So 10% will be 11,37. We want to round off. so that the balance carried down will be 1863. How much? 11 plus 1 is 12. 12 minus 3 should be 9. So 9509. Please make sure you are computing. That will be the opening, 9509. 10%, if you round off, 951. Then you get 7460. Then 7460, 746, 5206. If you copy my answers, that's what they are. 5206, 521, 2727, 2727, 273, nil. Basi, fika hapo. Pole pole. Wewe kama wewe, usikopi answer zangu. Once you're done, you can confirm by saying, you just say in order, kama iko sawa na zako. Someone can confirm? Olivia has just confirmed. Good. So let's derive our current and non-current from there to make our work easier as we proceed. So non-current assets is the part of investment you don't expect in 1 year. So outstanding in 2017 is 5909. Out of this, there is part of it we will receive in 1 year, that is current. What will remain after 1 year is non-current, non-current. So of 9509, what will remain after 1 year is this one here, 7460. So 7460 is long term in 2017. Out of this will remain after 1 year. So what is remaining after 1 year is long term. So the difference between 9509 and 7460 is short term. So what is 9509 minus 7460? Can you give me the figure there, which is short term? It will be how much? $20.49. So 2049 is short term. We go to 2018. 2018, outstanding 7460. Out of this will remain after 1 year. So you bring 5206. So 7460 minus this is short term, which will be 7460 minus 5206. 2252. That's the short term. Out of this will remain after 1 year. So here you bring 2727. So 5206 minus 2727 is 2479. We have this one. When you check ahead, 0. So the whole amount must be paid in the next 1 year. When you check here, nothing. Please don't just copy figures, make sure you are flowing. So if you are comfortable, the phone is misbehaving. When you are comfortable with those answers, then we can answer the question now. The question was to prepare P&L extract, then we prepare the balance sheet extract. So profit stock loss extract. So we are in the books of the lessee. Who is the lessee here? Where would you see lessor? Remember, this is the books of the lessor. So 2017, 18, 19, 2020, 2021. So shillings are in thousands. So lessor talks of income. So income is the finance. The finance income. Here, you pick this column. 1137, 951, 746, 521, 273. Only that, there is nothing else. So collect that, then we do the balance sheet extract to finish that question. Thank you. So we go to the statement of financial position. I hope everyone is done. The way I know you are speed, Maliza. So let's go to the balance sheet extracts. So statement of financial position. Have that. Recap of statement of financial position extract in the books of the lesson. Have those years. Then have this for me. Lesson talks of the assets. So non-current investment, then current investment. The same thing could have been in the books of the lessee about doing equal liabilities. So non-current obligation, current obligation. But even the computation remains the same. Correct in a change. Just remains the same. So we have the figures, they are here. So you just collect them. So 2017, 7460, current 2049. Unapata hiyo total ya 9509. 2018, 5206, 2254. Unapata 7460. 2019, 2727, 240, 2479, 5206. 2020, 0, 2727, 2727. 2021, nothing, nil. Don't copy. Make sure you're seeing them. I'm getting them from here, please. Getting them from here. That's why I wanted to bring this extension to make our work easier ahead. So we have covered both the books of the lessee and the books of the lessor. So there's something I want to tell you before I wind up. All right, so what I wanted to say is that the two questions we have done, the receipt or payment was being made at the end of the year in arrears. Arrears means after the period. What if someone wants to pay in advance? If mkianza analipa. So that is the one which is being covered by illustration 3, which we'll start from in our next class. So right there, lease payments in advance. Lease payment in advance. So that is the one we shall start with. When is our next class? I want to see if people are standby. When is our next class? When is our next class? Saturday, that is tomorrow from 6 p.m. Yes, just in case someone had forgotten. For tomorrow, we have a class 6 p.m. to 9 p.m. Maria, to 9 p.m. So kule vizuri before 6 to sustain you up to 9 p.m. So 9 tutakuwa tumaliza mambo ya lease na tumeingia huko kwingine in other things. Otherwise, I wish you a happy holiday. Those who are going to, those who are traveling, be safe. Those who are at home, also be safe. Thank you.